Hi everyone, and welcome to this week's CyMax FinTech Weekly Market Insight. It's broken down into 4 parts as usual. Part 1 is where we look back at the events of last week. First of all, our disclaimer. So trading does involve the potential risk of loss of capital and is not suitable for everyone. Hopefully it is for you though. And as many companies provide leverage, just be careful because you can lose substantially more than that initial investment. Everything that we include in here is just purely for educational purposes, and we are not trying to encourage you to trade or invest. That must be your decision. And of course, carefully consider the risks involved, your financial situation, your level of experience, and of course your risk appetite. Only risk capital you're prepared, but more importantly, you can afford to lose. Just keep it as a small percentage of your overall capital. And if you've got any doubts whatsoever, seek independent financial advice before you risk that capital. Okay, so we've got lots to get through this week. So first of all, let's have a look back at last week. So, well, wasn't it an eventful week with the Fed pausing rather than skipping rates, and the ECB hiking and warning of more to come at their next meeting? Then, of course, in the US, CPI came in, it was really sort of right in the middle for me at 0.4% month on month. And the Fed just considered that enough to merit a pause. It was helped with gasoline and airfares lower, along with education. Although that was offset a little bit with higher rent and used autos. New car prices do seem to be coming down in the US, but it takes a few months for that to filter through into the data and also into the market. So that may again just add a little knock on inflation in 2 or 3 months' time, especially with summer coming up. PPI was negative 0.3% month on month, which gives us 1.1% year on year, with core 0.2% up month on month, showing 2.8% year on year. So that is sort of, it's getting there, but it's still not ideal for the US as well as many other countries. The US Treasury have been issuing a variety of bills and notes as they try to sort of refill the coffers, but they've got a lot more to do yet. I'll cover that when we get into the macro. Now, even though Powell sort of paused on rates, he did remain hawkish. And if you look at that dot plot, it did show that there's potential for 2 more hikes this year if inflation does remain that little bit too high. And he also suggested that rate cuts are possibly years away. I have warned of this so many times. They're going to be higher for longer. Low rates are for a crisis. And the dollar weakened further, especially with the ECB hiking and sounding very hawkish. And of course there's expectations of the approaching Bank of England meeting this week that rates will go up there as well. Now, initial jobless claims did rise again in the US to 262,000, which was higher than forecast, so it did surprise a little bit. And there was also a huge oil build of almost 8 million barrels, which again wasn't expected. So stocks pretty much had their best close since March. Good performance so far. The S&P sort of bounced back, and it's got back sort of 20% from its low, so it's now back in an official bull trend, but we'll have to wait and see if that can continue. Retail sales were up 0.3%. Capacity utilization was close to 80. Now 80 to 84 is considered growth, so it's not that far off. But again, that's still a concern because growth, when rates are still being hiked, as they have been over the last year, it's still a little bit sort of contradictory. And Michigan consumer sentiment was a big beat at 63.9. So especially in America, they just won't be beaten for the moment. The consumer's still there and still willing to spend. The dot plot probably did surprise with two more potential hikes, but of course that's if the data merits it, and that's going to be very much around the inflation data. Now, as these hikes are slow to sort of develop and show in data, the next month or two will be interesting to see, if the inflation does drop more, despite the fact that they didn't hike. So the Fed stuck at 5.25%. Possibly it could go up to 5.6 this year, but of course that's going to depend on inflation. And then, according to the dot plot, it looks as though it's going to drop to 4.6% next year. Rates, this is not inflation. And following year, 3.4% in 2025. And then really sort of going further forward, they're looking at probably about 2.5% interest rates. Just note that these are the averages of the mean of the dot plot, not necessarily because there's mixed views as usual in those dots. Now, the ECB put rates up and they're now 0.25%, so they're now at 3.5%. Inflation's still high, but when we look at the data, not so great. ZEW sort of economic sentiment survey, and emphasis again, it's a survey, so how many people responded, was much lower at -10. Industrial production 1% month on month, which is only 0.2% year on year. And CPI core came in at 5.3% and headline 6.1%. So again, that's still too high. Germany CPI came in there at 6.3% year on year, although ZEW was lower than expected at 56.5 for the current, but better than forecast, sort of -8.5. Now in the UK, we've still got these average earnings that are much higher again, coming in at 7.2%. Plus the jobless data sort of was lower than expected, and unemployment dropped back to 3.8%. GDP was 0.2% month on month. Industrial production still weak, and I think that's a global issue, not just a UK issue for sure. That was -1.9% year on year, and manufacturing was 0.3% month on month. So in all, it's probably enough for the Bank of England to hike again. The UK does struggle with inflation once it sets in. And as we've seen, the euro and the pound gain against the USD this week. I see it, but I don't believe it's going to happen long term. But I could be wrong. Now in China, they added stimulus from retail, because retail sales were dropping. They were down 12.7%. So they've trimmed some of their rates, and of course they've got a rate decision coming up this coming week. Again, is this going to boost inflation again if they sort of go heavy with sort of trying to stimulate the economy there, which will then filter out into the rest of the world? And then in Canada, housing data was weaker than expected, and to a degree I can see that. And then in Australia, unemployment dropped to 3.6%. So, we're not seeing that increases in unemployment yet, but, we've still got another 6 months of this year to go. Now, in crypto, so that became under pressure, and this is basically around the SEC actions against exchanges and classification of some of the coins as securities. So again, just keep, if you're involved in the crypto sector, obviously you'll know that, but just keep an eye on that. And of course, there's lots to move the markets in the next part 2, where we look at the week forward. So hope to see you in that bit. Before we do that, we'd like to sort of obviously just highlight what we do. Apart from these YouTubes, we provide a daily newsletter which gives you sort of global news, my views, and also a subscription service is fresh daily chart levels, which include pivot points. We offer one-day workshops, one-week courses, comprehensive master classes. It really depends what level you're at, and of course what level you want to achieve. Now, going forward, also with one of our one-week courses and our masterclass, that we also now include a free challenge. One of these, challenges to try and get a funded account. Now, that's a great way if you feel that you're undercapitalized or you just don't want to actually use your own capital to go forward. And we have just sort of 1 or 2 different challenges that you can select from there. That will start from the August-September masterclass. Now, trader mentoring, we offer that just to help individuals to get to that next level time and again. We consult to companies, corporations around their FX exposure and commodity exposure, just providing sort of robust but flexible hedging strategies for them. And of course, we provide trader education. Content to individuals, exchanges, brokers. I'm quite active. Saturday I was in London and I was presenting there at a trade event, and also talking along with a panel of others about our career so far, and our journey, and where it's got to and where we see it going. And as I mentioned, if you've got those sort of aspirations but not the capital to become a trader, then the funded trading account may be the route for you. You can do that directly, or if you want to gain some sort of serious, decent education before you do that, then join one of our courses and we'll actually provide the challenge for free. Okay, if you want to contact us for details of any of this or got any questions, then it's info@cymaxfintech.com. My email, chris.tubby@cymax-int.com. And look forward to seeing you in part 2.